Hello, everyone, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're tackling one of the most important topics for any investor, whether you're just starting out or you've been in the markets for years. We're diving into how to protect your wealth in the face of two powerful and often disruptive economic forces: inflation and deflation. Now, these aren't just abstract economic terms you read about in textbooks. Inflation and deflation shape the real world value of your money, your investments, and your long term financial security. And as we look ahead to 2026, it's becoming clearer than ever that investors need strategies to handle both. So, in today's episode, I'll be breaking down the best inflation hedge assets for 2026 and also pointing out the most reliable safe havens during deflation. By the end, you'll have a clear picture of how to build a resilient portfolio no matter which way the global economy turns. And stick around to the end because I'll also share some powerful tools that can help you put these strategies into practice right away. Segment 1: Inflation versus Deflation Basics. Let's start with the basics just to make sure we're all on the same page. Inflation is when prices rise across the economy. A little bit of inflation is normal, even healthy, because it encourages people to spend and invest instead of just hoarding cash. But when inflation gets out of control, it starts eroding purchasing power. Think about the 1970s in the United States, when inflation climbed into double digits. That period was brutal for savers and retirees because the money in their bank accounts bought less and less each year. Deflation, on the other hand, is when prices fall. At first, that might sound good. Who doesn't like cheaper prices, right? But here's the problem. Falling prices often signal weak demand. Companies start cutting costs, which usually means layoffs. Profits shrink. People delay spending because they expect prices to be lower tomorrow, which creates a vicious cycle. A good example of this is Japan in the 1990s, often called the lost decade, when deflation persisted and economic growth stalled. So both inflation and deflation can be destructive if you don't have a plan. And that's why hedging, protecting your portfolio, is so important. Segment 2: Best Inflation Hedge Assets 2026. Let's tackle inflation first. Looking ahead to 2026, the risks of high inflation are still very real. We've got geopolitical conflicts, ongoing supply chain disruptions, and rising wages in many sectors. All of these push costs higher. So, what are the best inflation hedge assets for 2026? Let's break it down. Number 1, commodities and energy. These are the most direct hedges against inflation. When input costs rise, producers pass those costs on and commodity prices climb. Oil, natural gas, copper, aluminum, all of these tend to move upward during inflationary periods. Investors can gain exposure through futures, ETFs, or by investing in companies that produce these resources. Number 2, precious metals, gold and silver. Gold is the classic inflation hedge. It's tangible, it's scarce, and it isn't tied to central bank decisions. Silver offers similar protection, but it has a twist. It's also an industrial metal. It's used in electronics, in solar panels, and in green energy projects. As governments worldwide invest heavily in renewable energy, silver's demand has a dual boost, both as an inflation hedge and as a critical industrial material. Number 3, Treasury Inflation Protected Securities, or TIPS. These are U.S. government bonds designed specifically to protect against inflation. Their principal value rises with inflation, so you don't lose purchasing power. If you're looking for a conservative, lower risk way to hedge, TIPS are a reliable option. Number 4, real estate and REITs. Real estate is another traditional hedge. Property values usually rise during inflation, and rental income tends to keep pace with living costs. If you don't want to deal with direct property ownership, real estate investment trusts, or REITs, give you exposure to the sector with the added benefit of liquidity. Number 5, equities in defensive sectors. Not all stocks do well in inflationary times, but certain sectors shine. Think healthcare, utilities, and consumer staples, products people need no matter what. Companies in these industries often have pricing power, which means they can pass on higher costs to consumers without losing demand. And number 6, cryptocurrencies selectively. Bitcoin is often described as digital gold because of its limited supply. While crypto is undeniably volatile, its adoption is expanding. By 2026, with more regulation and more institutional involvement, crypto could play a role as part of a diversified inflation hedge strategy. Segment 3: Safe havens during deflation. Now let's flip the coin and talk about deflation. While it's discussed less often, deflation can be just as damaging. Falling prices discourage spending, companies cut back, and debts become harder to repay. If inflation is about your money buying less, deflation is about your money buying more, but in an economy that's shrinking. So, what are the best safe havens during deflation? First, cash and high quality bonds. In deflation, cash is king. The real value of your dollars increases as prices fall, and having cash gives you flexibility to buy discounted assets. High grade bonds, like U.S. Treasuries, are also valuable because they remain stable and provide steady income. Second, long duration treasuries. These are especially powerful in deflationary environments. When interest rates fall, the price of long term bonds rises, delivering solid returns. While not exciting in boom times, they shine when deflation takes hold. Third, dividend paying stocks. Companies that pay consistent dividends, like utilities or consumer staples, tend to hold up better during downturns. They provide income even when capital gains are harder to come by. Fourth, gold. Yes, gold again. While most people associate it with inflation, gold also serves as a hedge in deflationary scenarios. When confidence in financial systems weakens, gold stands tall as a universal store of value. Fifth, defensive real assets like farmland. Even during deflation, people need food. Agricultural land continues to generate value because it produces something essential. Farmland is often overlooked, but it's a robust hedge in both inflationary and deflationary environments. Segment 4: Building a balanced portfolio. So, how do you actually put this all together? The tricky part is that inflation and deflation risks can exist at the same time. For example, energy prices might soar while technology products get cheaper due to innovation. This is where a barbell strategy comes in handy. On one side of the barbell, you allocate assets that hedge against inflation, commodities, gold, real estate, and tips. On the other side, you hold assets that hedge against deflation, like long-term treasuries, cash, and dividend-paying stocks. This way, you're not trying to predict the future with certainty. Instead, you're building resilience into your portfolio. You're covered whether prices rise or fall. Segment 5: Why 2026 matters. Now, you might be wondering, why focus on 2026? Here's why. First, geopolitical shifts are shaking global trade. Conflicts in Europe, tensions in Asia, and supply chain realignments are all inflationary pressures. Second, the debt overhang is massive. Governments and corporations are carrying record-breaking levels of debt. If interest rates remain high, defaults could trigger deflationary spirals. Third, technology continues to exert deflationary pressure. Artificial intelligence, robotics, and digitization are driving down costs and automating jobs. And finally, central banks are walking a tightrope. Tighten too much, and they risk triggering deflation. Ease too much, and inflation runs hot. By 2026, this balancing act may create volatility we haven't seen in decades. Segment 6: Tools and resources. Now let's talk tools, because knowledge is useless without execution. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, I highly recommend checking out Crystal Ball Markets. Their platform makes it easier to manage hedging strategies across multiple asset classes. And if you want to keep learning in a practical, beginner-friendly way, subscribe to the Crystal Ball Markets podcast. It's packed with insights on trading, investing, macroeconomics, and financial markets explained in plain English. It's a perfect companion to what you're hearing here. Closing thoughts. So, here's the big takeaway. Inflation and deflation are two sides of the same coin. Both can disrupt markets. Both can destroy wealth. But both can also create opportunities if you're prepared. By diversifying into the best inflation hedge assets for 2026 and the most reliable safe havens during deflation, You can build a portfolio that not only survives shocks but thrives through them. The future isn't predictable, but your preparation is. Start building resilience now, and you'll thank yourself in 2026 and beyond. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, your host. If you found this episode valuable, be sure to share it with a friend or colleague, and don't forget to check out our recommended tools and resources. Until next time, stay informed, stay strategic, and keep trading smart.